Welcome to Daily Crypto episode 50. Get ready for a deep dive into the most impactful shifts happening in the digital asset space right now. We're cutting through the noise to bring you the essential insights and some surprising facts you need to stay ahead.
Exactly. Today, we'll explore everything from how major financial players are, repositioning their portfolios to the latest market movements, fascinating regulatory developments, and what's driving the next wave of innovation in blockchain technology. Our goal is really to give you a comprehensive understanding of where crypto stands today and, well, where it might be headed, equipping you with the knowledge to truly grasp this evolving landscape.
Okay, let's unpack this. When we talk about significant shifts in the financial world, it's impossible to ignore the perspectives of seasoned investors. And lately, one particular viewpoint has really captured attention. It feels like it's signaling a potential seismic shift, maybe,
Yeah.
in how traditional finance views digital assets. It's a conversation that's been gaining serious traction and, for good reason.
Indeed. The discussion around crypto's, let's say, legitimate role in a broader investment portfolio has gained significant new weight, especially with highly influential figures like Ray Dalio weighing in. Dalio, as many of you know, founder of Bridgewater Associates, one of the world's largest hedge funds. His investment philosophy is rooted in understanding macroeconomic cycles, asset diversification.
Right. He's known for that deep systemic analysis.
Exactly. And what's particularly noteworthy is his recent suggestion. He's suggesting investors allocate a substantial 15%, 1 to 5, of their portfolios to store of value assets. And the striking part, he explicitly mentioned both Bitcoin and gold in this category. This isn't just, casual remark or some fleeting prediction. It's a specific substantial percentage coming from someone who's navigated global markets for decades through crises and booms. This kind of endorsement, well, it carries immense weight. It signals a real maturation in how digital assets are perceived.
And his recommendation, it doesn't come out of nowhere, right? It's framed within his profound concerns about something pretty significant, a potential U.S. debt doom loop. That sounds
What, pretty serious?
almost apocalyptic. Could you elaborate on what a debt doom loop implies,
Yeah.
economically speaking, and why would that prompt recommending Bitcoin?
Yeah, it implies a self-reinforcing cycle, a highly destructive one for a national economy. Essentially, a debt doom loop is a scenario where a country's government debt gets so overwhelmingly large that a huge chunk of its national budget has to go just to servicing that debt, just paying the interest. And as the debt grows, the perceived risk of default or maybe severe inflation, it increases among investors, which in turn leads lenders to demand even higher interest rates to compensate for that risk.
A vicious cycle.
That's exactly. These higher interest rates then make it exponentially more expensive for the government to service its existing debt and to issue any new debt. So it spirals the country further and further into indebtedness. Dalio's concern, it stems from the unprecedented scale of America's national debt, unfunded liabilities, suggesting that traditional assets, traditional mechanisms within the established system might become increasingly vulnerable. In that kind of environment where fiat currencies, government bonds, they're at risk of devaluation or default. Investors typically seek assets that are less correlated with the traditional system, things with inherent scarcity or a long history of preserving value.
Like gold.
Like gold, the historical store of value. And crucially, like Bitcoin, a modern digital equivalent. It has that mathematically capped supply, censorship-resistant properties. He sees them both as crucial hedges against a potential collapse of confidence in fiat currencies.
So if you're listening to this, why is a recommendation from a traditional finance heavyweight like Dalio so impactful for you? It's clearly not just another, fleeting price prediction from a crypto enthusiast, is it?
Precisely. This recommendation signals nothing less than a potential paradigm shift. A shift in how mainstream finance views digital assets. For years, Bitcoin was largely dismissed by most traditional finance veterans, called speculative, niche, suitable only for high-risk tolerance, maybe even gambling. Dalio's suggestion, though, it fundamentally repositions Bitcoin. He's not advocating for a speculative trade. He's advocating for a strategic long-term portfolio allocation.
Moving into a different category entirely.
Absolutely. From speculative gamble into the category of legitimate hedge. A hedge against significant macroeconomic instability. Specifically, the kind of large-scale financial challenges he anticipates from this debt doom loop scenario. This validates Bitcoin's utility as a serious store of value on a much broader institutional scale, and it has the potential to profoundly influence how large endowments, pension funds, other traditional institutions structure their allocations. When someone of his stature, with his track record, makes such a compelling, well-reasoned call, well, it resonates. It prompts others to reevaluate their own positions, potentially unlocking massive new flows of capital into the digital asset space.
That's a strong long-term view, positioning Bitcoin as a strategic hedge. But how does this connect to what we're seeing right now? In the short to medium term, is the market reacting to these macro concerns, or is something else driving the immediate price action?
Oh, it absolutely is reacting. It's a fascinating interplay. We've recently seen Bitcoin nearing, that $120,000 mark, and market analysis is predicting larger price swings ahead. This suggests that while there are these deep underlying macroeconomic concerns driving long-term strategies, immediate market dynamics are also heavily influenced by speculation, by momentum, the sheer influx of new capital.
So a mix of forces.
A real mix. The market is attempting to price in all these evolving factors simultaneously, from the increasing institutional interest, spurred by endorsements like Dalios, to the ongoing macro uncertainties like the potential debt doom loop, even geopolitical tensions. The potential for larger price swings, it indicates high volatility, which, can be both a risk and an opportunity. It suggests capital is actively moving, seeking refuge, or aiming for growth. And the market is undergoing this complex process of price discovery as it digests these multifaceted influences. It's a dynamic environment where long-term fundamental shifts meet short-term trading impulses.
Okay, here's where it gets really interesting. Let's zoom in from that macro view, the overall market sentiment, to the specific assets themselves. Starting with, well, the undeniable king of crypto, Bitcoin. It truly holds a unique position, especially when you consider its scarcity. It feels almost mythological at this point.
Bitcoin's scarcity isn't just a talking point, it's foundational. Foundational to its entire value proposition, its revolutionary nature, arguably. When we talk about how rare it is to own a significant amount, the stats are, well, quite striking. Fewer than 1 million people on Earth currently hold a full Bitcoin.
1 million out of everyone.
Fewer than 1 million. To put that into perspective, that's less than 0.02% of the global population. And if you narrow that down just to the broader crypto community, which is already tens of millions, the percentage holding a full Bitcoin is even smaller, much smaller. Compare that to the number of millionaires globally or people owning significant amounts of gold, real estate. This extreme rarity isn't just a fun fact. It has profound, lasting implications for its long-term trajectory, its role in the global financial system.
So what do these implications of such extreme scarcity mean? For Bitcoin's long-term value proposition, its potential as a digital store of value. For you, the listener, does this information change your perspective on accumulating Bitcoin or how you view its future potential, especially with that finite supply?
It absolutely should provoke some reconsideration. This extreme scarcity inherently supports Bitcoin's long-term value proposition. It solidifies its position as a unique digital store of value, akin to digital gold. Unlike traditional fiat currencies, which can be printed, well, seemingly without limit, or even gold, which is still being mined, Bitcoin has a mathematically capped supply, 21 million coins, that's it. And it has that deflationary issuance schedule, the halving every 4 years or so.
Right, the supply gets tighter over time.
Exactly. So if demand continues to grow, driven by factors like macroeconomic instability, increasing institutional adoption, or just individual desire for a censorship-resistant asset, while the supply remains fixed and is increasingly distributed among this tiny fraction of the global population, then basic economics, supply and demand, dictate its value should appreciate significantly over time. This fact reinforces the idea that owning even a fraction of a Bitcoin today could prove incredibly significant long-term. It challenges the traditional view of currency, of wealth, positioning Bitcoin as this truly scarce digital commodity, one that cannot be debased by central banks or governments, fundamentally changing how you might view long-term savings, wealth preservation in a digital age.
And this rarity, it isn't just recognized by individuals or, small groups. We're even seeing governmental interest in accumulating Bitcoin. That adds another compelling layer to its perceived value, its strategic importance. This isn't just about financial markets anymore, is it?
That's a crucial point. And it speaks to Bitcoin's transition from purely speculative asset to, well, perhaps a geostrategic one. For example, the U.S. government is actively seeking the forfeiture of, I think it was 20.2 BTC, seized from the Chaos ransomware group by the Dallas FBI. This isn't merely about recovering illicit funds. It's part of a broader emerging strategy. These seized Bitcoins are being added to what's being described as the country's proposed strategic Bitcoin reserve.
A strategic Bitcoin reserve, like a strategic oil reserve.
Something like that concept, yeah. This governmental interest in accumulating Bitcoin signals a growing recognition of its strategic importance. perhaps viewing it as a national asset alongside traditional reserves of gold or foreign currencies. It demonstrates that major global powers aren't just regulating crypto, they're also exploring its potential role in national economic and security frameworks. Imagine a nation holding a significant reserve of a digital asset that's outside the control of any single government, resistant to inflation, globally transferable. This shifts the narrative significantly, underscoring Bitcoin's value beyond just speculative investment. Positioning it as a tool in the evolving geopolitical and economic landscape, it's a powerful validation of its long-term enduring value.
That's a powerful statement about Bitcoin's future, its role on a global stage. But of course, Ethereum is always a focal point, for different reasons, right? With its own unique set of fascinating market dynamics, a narrative much more about utility, innovation, beyond just store of value.
Indeed. Ethereum, number 2 by market cap, it presents a much more complex, more nuanced set of market signals than Bitcoin. On one hand, we're seeing evolving ETH futures data hinting at a potential rally. Some analysts predicting quite confidently a breakout to $5,000. Futures data often reflects institutional sentiment, large-scale leveraged positions, suggests underlying optimism among sophisticated traders betting on a significant upward move. But, on the other hand, other traders are predicting a lower support retest before any significant breakout, maybe expecting a dip to around, say, $3,500, $3,800 before a decisive move towards $4,000.
So conflicting signals, bullish underlying sentiment, but also some caution.
Exactly. These conflicting signals indicate that while there's strong underlying bullish sentiment, there's also a degree of caution, uncertainty, reflecting the current volatility and an intense battle between buyers and sellers. It speaks to the ongoing dynamic price discovery process for ETH, where different market participants interpret the same fundamental data in, well, divergent ways.
So what specific factors are playing into these varying predictions for Ethereum's price? What's holding it back from consistently pushing and, staying above that $4,000 mark, even with positive indicators like institutional interest?
There are a couple of key factors at play creating this push and pull. Firstly, we're witnessing significant ETH treasury buying. Companies actively accumulating Ethereum for their corporate treasuries. This means they're not just trading it speculatively, they're treating it like a corporate reserve asset, like holding gold, cash, short-term bonds, recognizing its long-term value and utility.
Okay, that's one bullish factor. What's the other? Secondly, there are consistent spot ETF inflows. Unlike futures ETFs, which track price via derivatives, spot ETFs hold the actual underlying asset, meaning every dollar flowing into these funds creates direct buying pressure for Ether on the market. These are both very significant bullish indicators, showing increasing institutional adoption, demand for ETH as a foundational asset. However, despite these strong signs, these factors haven't yet been sufficient to consistently push the price decisively above $4,000 and maintain that level. Could be broader market resistance, maybe profit-taking by early investors, or simply the sheer volume of buy pressure needed to overcome that psychological and technical resistance point. It's a testament to the immense liquidity required to sustain a break above such a significant price level. And what about this concept of an Ether supply shock? We've heard it mentioned. What exactly is that? And what could its implications be for price dynamics, especially if demand keeps growing while the available supply continues to tighten?
An Ether supply shock refers to a scenario where the available supply of Ethereum on exchanges, or readily available for sale, dramatically decreases, while demand for it either remains strong or, intensifies. This can happen for several reasons. A significant portion of ETH is currently staked on the Ethereum 2.0 network, now the proof-of-stake consensus layer. That staking secures the blockchain, earns rewards, but also effectively removes that ETH from circulation. Another portion is locked in various DeFi protocols, providing liquidity or collateral.
So it's tied up, essentially.
Tied up, yes. And furthermore, with Ethereum's EIP 1559 upgrade, a portion of transaction fees are burned, currently removed from supply, making Ether a potentially deflationary asset under certain network conditions, especially since the merge. So if the amount of Ether available for purchase shrinks significantly due to these factors, any continued growth in demand from retail, institutional buyers, increasing use in gaming, enterprise solutions would create immense upward pressure on its price. It's classic supply and demand. Extreme scarcity in the face of growing utility and adoption can lead to rapid, substantial price appreciation. Given Ethereum's deflationary mechanism now, a supply shock isn't just theoretical. It's a very real possibility analysts discuss often.
This sounds like institutional accumulation is becoming a major piece of the puzzle for Ethereum. Are there any specific examples of firms aggressively accumulating ETH as part of their corporate strategy?
Absolutely. The increasing institutional appetite for Ethereum is a truly significant trend, underscores its growing legitimacy. We're seeing firms like Sharplink Gaming emerging as major players in this corporate treasury movement. They are currently the second largest Ethereum treasury firm, right after Bitmine Immersion Technologies, holding substantial amounts of ETH on their balance sheets. What's particularly noteworthy is that Sharplink's Joe Lubin has explicitly expressed a strong desire to buy ETH faster than any other firm in the market.
Faster than anyone else. That's aggressive.
Very aggressive. This isn't just about holding, it's about active accumulation. It underscores a strategic shift, where companies aren't just investing in crypto, but actively building substantial corporate treasuries of digital assets. They view these holdings as integral to their long-term financial health, future growth, strategic positioning within the digital economy. Betting on Ethereum's role as a global settlement layer, a platform for dApps.
That's fascinating. But speaking of Bitmine Immersion Technologies, which you mentioned is the largest Ethereum treasury firm, I saw something quite intriguing about them. Bitmine actually tanked 27% in its stock price, despite actively touting ETH's implied value at $60,000. What exactly is going on there? That seems like an odd anomaly, especially if they believe in such a high implied value.
It is indeed an intriguing anomaly, and it perfectly highlights the sometimes disjointed nature of market sentiment versus long-term value assessment, particularly in this nascent crypto corporate space. Bitmine, despite being a leader in holding substantial Ether, clearly seeing this implied long-term value of ETH at a staggering $60,000, experienced that significant 27% drop in its own stock price. This divergence could be due to several factors, often unrelated to its direct ETH holdings. Could be broader market sentiment towards crypto-adjacent companies, which might still be seen as higher risk by traditional investors. Might be operational issues specific to Bitmine's mining or business model influencing its stock performance. Or perhaps simply a lack of understanding from mainstream markets on how to properly value a company whose primary assets are digital.
So the stock market isn't necessarily reflecting the value of their ETH holdings directly?
Not always, no. However, as David Grider, a partner at venture capital firm Finality Capital, noted, he believes the broader Ether treasury company boom should generally bode well for the long-term price and inflows of the token itself. So, while one company's stock might face individual challenges or market mispricing, the underlying trend of institutional ETH accumulation and its long-term potential remains fundamentally strong for Ethereum's ecosystem and price. It's a nuanced view. Shows that even with strong underlying asset accumulation, corporate stock performance can still be influenced by a multitude of other, often non-crypto-related, market forces and investor perceptions.
Okay, so a lot of moving parts for Ethereum, both strong institutional interest and some market complexities. Let's broaden our view. What about the other major players in the altcoin space? Are we seeing similar trends, or are entirely different narratives playing out across the wider digital asset ecosystem?
We're seeing a diverse mix, which truly speaks to the multifaceted nature of the crypto ecosystem beyond just Bitcoin and Ethereum. Take XRP, for instance. Been in the news for its ongoing regulatory battles, attempts to establish itself in cross-border payments. After a recent dip, market analysts characterized it as a healthy correction.
A healthy correction? What does that mean exactly in market terms? Is it actually good?
In market terms, yes, a healthy correction isn't necessarily bad. In fact, it's often viewed as a positive sign of market maturity. It means after a period of rapid price increase, the asset experiences a temporary pullback, maybe 10%, 20%, sometimes 30%. This can shake out over-leveraged positions, cool off excessive speculation, allow new buyers to enter at a more attractive price point. This process helps establish a more sustainable foundation for future growth, rather than a continuous unstable parabolic rise. It often signals the asset is consolidating, not entering a prolonged downtrend, which can be seen as positive for XRP's long-term stability and future movements.
Okay, that makes sense. A good fundamental market dynamic for XRP holders then. But then, on the other end of the spectrum, we've got Solana, making headlines for a very different kind of internal discussion, one that sparked quite a debate.
Indeed. Solana, known for its high-speed, burgeoning ecosystem, recently at the center of a rather heated internal debate, particularly concerning the value and purpose of certain digital assets built on its platform. A Solana co-founder controversially called meme coins and NFTs digital slop.
Digital slop! Wow, that's blunt.
Very blunt. And it provides a fascinating glimpse into the internal discussions, the differing philosophies within crypto ecosystems, even among pioneers of a specific blockchain. This strong statement highlights a significant tension. On one side, those focused on serious utility-driven projects, enterprise solutions, DeFi infrastructure, scalable apps. On the other side, the more cultural, speculative, or experimental segments. Meme coins driven by internet culture, NFTs representing digital ownership of art or collectibles. This kind of public internal critique can spark important conversations about what truly adds fundamental value to a blockchain network, where development resources should focus for long-term sustainability. But it also reveals a lack of full consensus, even among the most influential figures, showcasing the diverse, sometimes clashing visions for crypto's future.
That's quite a strong and divisive statement indeed. But moving to a different altcoin, one with strong institutional backing, focused on emerging tech. What's happening with Sui? It seems to be attracting some serious capital.
Sui is indeed seeing significant institutional confidence, strategic investment. Speaks volumes about its perceived potential. NASDAQ-listed Mill City Ventures has earmarked a substantial $441 million towards a Sui treasury. After a successful $450 million raise, this makes them the first public company to invest directly in a Sui treasury, a very notable, pioneering step for a publicly traded entity. And crucially, their investment rationale isn't just general crypto exposure. They are explicitly betting on Sui's blockchain's AI and DeFi capabilities.
AI and DeFi capabilities together on Sui.
Exactly. This highlights a significant emerging convergence of trending technologies, artificial intelligence and decentralized finance. It suggests institutional players are increasingly looking for blockchain platforms that can support complex, high-value applications beyond simple transactions, particularly those that can seamlessly integrate with emerging AI tech to enhance financial services, automate processes, create novel financial products. It's a clear signal that the future of blockchain might lie at this intersection of AI and DeFi, driving efficiency and sophistication in decentralized systems.
And what about Tron? They always seem to be ambitious, continually looking to expand their footprint.
Tron Inc. is certainly demonstrating aggressive, ambitious expansion plans, particularly around increasing its holdings of its native token, TRX. They are actively seeking $1 billion to grow their TRX holdings. That indicates a massive capital injection into their ecosystem. This ambition comes as their stock is already rallying, suggesting investor confidence in their existing strategy. This move signals a clear strategy to increase market presence, enhance network security through more distributed holdings, potentially exert greater influence. Such a substantial capital raise is likely aimed at further ecosystem development, fostering dApp growth, solidifying Tron's position as a major player. Reflects a project's focus not just on tech, but also on strategic financial maneuvers to expand its network and influence.
And then there's that particularly unusual pivot we saw recently involving BNB. Really stands out as an example of the kind of extreme market reactions these shifts can provoke.
This is a truly fascinating, somewhat bizarre case. Exemplifies the extreme market reactions to strategic shifts into crypto. Canadian vape company CEA Industries, previously focused on regulated cannabis vape products, saw its shares jump by an astounding nearly 550% after revealing plans to pivot dramatically into a BNB treasury firm.
A vape company becoming a BNB treasury firm. Seriously.
Seriously, what makes it even more intriguing, adds significance, is that this pivot is reportedly backed by a firm tied to Binance co-founder Changpeng Zhao. This showcases a remarkable phenomenon. Traditional companies, even from seemingly unrelated niche sectors, making drastic, almost overnight shifts to integrate crypto into their core business or treasury strategy. The market, in turn, responding with incredible enthusiasm. Perceiving these moves as significant value drivers, often driven by speculative fervor, the allure of crypto narratives, it's a vivid illustration of how the crypto space continues to attract and reshape business models in surprising ways, sometimes with little regard for underlying business fundamentals, purely based on perceived potential digital asset exposure.
It's becoming abundantly clear that institutions aren't just, observing the crypto space anymore. They're strategically repositioning themselves, often in surprising ways, sometimes even completely changing their business models. What does this broader, accelerating trend of institutional involvement look like across the board?
It's truly a profound and accelerating shift. Indicates a comprehensive integration of digital assets into the strategies of major financial players and corporations. One clear example is Cathie Wood's ARK Invest, known for focusing on disruptive innovation. They recently added a significant $20 million in BitMine shares, the firm we discussed, holding substantial Ethereum, while simultaneously scaling back exposure to companies like Coinbase, Block, Robinhood. This isn't just adding crypto to a portfolio, it's dynamic adjustment. a sophisticated reshuffling of their crypto-related holdings.
So they're actively trading within the crypto space, not just holding.
Exactly. This move reflects evolving strategies, perceived opportunities within the digital asset ecosystem. Perhaps a preference for direct exposure to underlying assets through treasury firms rather than investing in intermediaries, or a strategic reallocation based on their internal valuation models, future outlook for different segments of the crypto market. Shows that even leading-edge investment firms are constantly optimizing their portfolios in response to market signals, emerging value propositions, adapting to the rapidly changing landscape.
So we're seeing these nuanced portfolio adjustments. But are we also seeing companies going all in, really focusing their core business entirely on crypto, shedding traditional operations?
Absolutely. A compelling and increasingly frequent trend is companies making the strategic decision to go pure-play crypto. A prime example is Bakkt Holdings. They recently announced an agreement to sell off their loyalty services business, a significant part of their traditional operations, precisely because they want to focus purely on their crypto offerings. This signifies a powerful trend of specialization, where companies consolidate their efforts to become dedicated crypto entities. They're recognizing the crypto market has matured sufficiently, holds enough standalone opportunity to warrant a singular focus, rather than just being one division within a diversified portfolio. Demonstrates a deep-seated, long-term commitment, belief in the sector's growth potential, often comes with the strategic advantage of increased agility, dedicated resources for crypto innovation.
That's a strong statement of commitment indeed. And speaking of traditional finance giants, it's not just investment firms making moves. We're seeing them explore stablecoins, which could be massive for the broader financial system.
This is perhaps one of the most significant indicators of crypto's mainstream integration. Interactive Brokers, a major player in traditional brokerage, millions of clients globally, is now actively exploring a stablecoin launch. This move places them squarely alongside other traditional finance behemoths like JPMorgan Chase and Citigroup, both of whom have already launched or are deeply looking into their own stablecoins. JPMorgan has its JPM coin for wholesale payments, for instance.
So the big banks are definitely involved now.
Definitely. This widespread interest indicates a growing, undeniable recognition of stablecoins, not just as niche crypto assets, but as a fundamental, indispensable component of future financial infrastructure. Established players see the profound utility in these digital dollars for faster, more efficient, potentially cheaper transactions, streamlining internal settlements, creating new financial products, leveraging blockchain's programmability. It definitively blurs the lines between traditional banking and the digital asset space, signaling deeper, irreversible integration of blockchain technology into the very core of the mainstream financial system.
Beyond stablecoins, are there other tangible, real-world examples? Blockchain tech being implemented right now to tangibly improve efficiency in traditional financial services. It's easy to talk theory, but where's the rubber meeting the road?
Yes, a very clear and impactful example comes from cross-border payments, an area historically plagued by inefficiencies. CBI Bank, a traditional financial institution, is setting a new benchmark in this area with its Kima network integration. Historically, cross-border payments have been notoriously slow, costly, opaque, often taking days to settle, incurring multiple intermediary fees. By integrating blockchain technology via the Kima network, CBI Bank is directly addressing these inefficiencies. This provides a tangible operational example of how distributed ledger tech is being implemented to drastically improve speed, reduce costs, and increase transparency in one of the most fundamental high-volume aspects of global finance. It's not just theoretical. It's a real-world application bringing immediate, measurable benefits to the bank and its clients, demonstrating how blockchain can optimize existing financial processes without necessarily replacing them entirely.
And we touched on these briefly earlier, but it's worth revisiting the sheer scale of these corporate treasury plays we're seeing. These aren't just companies investing in crypto as a side bet. These are companies actively holding and managing significant crypto assets directly on their balance sheets as part of their core corporate strategy. It feels like a sea change in treasury management.
Exactly. Let's reiterate and emphasize the significance of those examples. Mill City Ventures earmarking $441 million for a SUI treasury, and the Canadian vape company, CEA Industries, pivoting entirely to become a BNB treasury firm. These aren't speculative buys on the open market from an investment fund. These are strategic corporate decisions for companies to hold and manage significant crypto assets directly on their balance sheets, part of their long-term corporate strategy. This signifies a fundamental shift in corporate finance, treasury management, where digital assets are treated as legitimate treasury assets alongside fiat currencies, traditional bonds, even gold.
Why are they doing it, though? What's the motivation?
The motivations are varied, but powerful. Could be for inflation hedging, exploring new revenue streams, diversifying their balance sheets, or strategically aligning with new business models that necessitate holding and transacting in digital assets. It reflects a growing confidence in the stability, liquidity, long-term value appreciation of these digital assets, and a sophisticated understanding of their potential to hedge against traditional economic risks or facilitate entirely new business models. This is about deep structural integration, not just fleeting market interest.
So for you, the listener, as you take in all these different threads, these movements are powerful indicators. What do they truly reveal about the crypto market's evolution and its place in the broader financial world?
They reveal that crypto is increasingly being woven into the very fabric of the core operations as strategic planning of major corporations and financial institutions. This is a monumental shift from just a few years ago. It means crypto is moving decisively beyond being a purely speculative asset class or merely a curiosity for tech enthusiasts and early adopters. It's becoming a foundational technology, an intrinsic asset type that will underpin future financial systems, new economies. It suggests digital assets are being recognized for their utility, their potential to offer new revenue streams, improve efficiency, act as strategic hedges against traditional financial risks. This mainstreaming means more liquidity, more robust infrastructure, greater regulatory clarity, and ultimately enhanced stability for the entire ecosystem. It's no longer a question of if crypto will integrate, but how deeply and how quickly it will reshape global finance. As crypto's footprint expands, so does the scrutiny from governments and regulators naturally. And of course, with more value at stake, security becomes paramount. It's a complex, multi-layered interplay, isn't it? It absolutely is. And it's a critical area for sustained growth, legitimacy of the crypto space. The regulatory and legal landscape is a constantly evolving challenge, but also a necessary sign of maturation. In the U.S., for instance, we're seeing significant activity. The SEC, the Securities and Exchange Commission, is currently delaying decisions on several prominent crypto funds, including the highly anticipated Truth Social Bitcoin ETF and Grayscale's Solana Trust. These delays extend the review periods, creating uncertainty, impacting market confidence.
Why the delays? What's the impact?
Each delay pushes back the timeline for these products to reach a broader mainstream audience through regulated investment vehicles. That can affect market sentiment, the pace of institutional adoption in the U.S., especially as the U.S. Congress continues to grapple with establishing comprehensive crypto regulation. It shows that while there's increasing political will to legislate, the process of actual approval for new crypto financial products remains cautious, often protracted. Reflects a complex dance between innovation and investor protection.
And alongside these specific ETF delays, there's also a broader legislative push in the U.S., particularly around central bank digital currencies, CBDCs. That seems to be sparking significant debate.
That's a key area of contention. Highlights a fundamental ideological divide regarding the future of money. Both the U.S. House of Representatives and Senate are actively focusing on crypto-related bills, notably an anti-CBDC bill. This proposed legislation specifically aims to curb the Federal Reserve's power over a potential digital dollar. The ongoing debate around CBDCs brings to the forefront deep concerns among some lawmakers, privacy advocates, about potential government surveillance, erosion of financial privacy, the possibility of a digital dollar becoming a tool for excessive governmental control over individual spending.
So it's about control and privacy, mainly.
Primarily, yes, and also concerns about the disintermediation of commercial banks. The political pushback against a U.S. CBDC reflects a strong desire to preserve financial privacy, limit governmental overreach into citizens' economic lives, maintain a decentralized financial system. This sets up a significant legislative battleground with profound implications for the structure of future finance.
Moving beyond the U.S., how do global regulatory hotspots compare? Are other regions finding clearer paths or facing similar hurdles?
We're seeing a highly diverse approach globally, creating a patchwork of regulations that crypto businesses must navigate. Dubai, for example, stands out. A beacon of clarity, a progressive stance. They have established robust frameworks enabling crypto property deals under clear VR rules. VR Dubai's Virtual Assets Regulatory Authority introduced a comprehensive regulatory framework, created a legally sound, transparent environment for crypto transactions and businesses.
So it's working there. People are actually using crypto for property.
Yes. As a result, major developers like DAMAC and EMAR are now openly accepting Bitcoin, Ethereum, various stablecoins for real estate transactions. This provides a positive, tangible example of legal, safe, large-scale integration of crypto into a major economy's property market. Showcases how, with well-defined regulatory guardrails, crypto can seamlessly integrate into traditional markets, opening new avenues for commerce and investment.
That's a stark contrast to some other regions, isn't it? Seems not everyone is moving at the same pace or with the same clarity.
It is indeed. While there are encouraging signs present in the UK with ongoing discussions, proposals for crypto regulation, reports indicate that UK crypto hopes are still stalling in terms of concrete, comprehensive frameworks, suggests a slower, more cautious approach, perhaps due to debates about aligning with broader international standards like MiCA in Europe, internal governmental coordination issues, or simply a more conservative stance compared to more agile jurisdictions like Dubai. This patchwork of regulations globally means complexity and compliance challenges for global crypto businesses and investors operating across borders.
And something else interesting globally is how countries are handling crypto wealth in relation to residency. We're seeing a trend regarding golden visas, which seems to reflect a tightening of rules.
Yes, there's a noticeable increasing trend of golden visas shrinking for crypto investors. Golden visas are programs granting residency or citizenship for significant investment real estate, government bonds, historically attractive to wealthy individuals seeking alternative passports or residencies. However, as crypto wealth has grown, jurisdictions are scrutinizing the source of that wealth more closely, particularly crypto-derived wealth. And tightening rules around obtaining residency through such investments reflects a broader global effort to prevent illicit finance, combat money laundering, ensure compliance with international tax regulations. Signals that crypto wealth is increasingly under the same microscope as traditional assets. Governments are becoming more sophisticated in tracing and taxing digital assets. For crypto investors, this means pathways to alternative residencies are becoming more restricted, require greater transparency regarding fund origins.
So on one hand, regulation trying to bring order, legitimacy, but then there's the very real, sometimes unsettling aspect of security, particularly for individuals. I saw a rather alarming term mentioned, wrench attacks. That sounds quite physical. What exactly are those, and how are they driving crypto investors towards centralized custodians?
Wrench attacks are a grim, disturbing reality. Highlight a unique security challenge in crypto beyond typical cyber threats. This term refers to physical coercion or extortion, where individuals are physically threatened, intimidated, even harmed. The wrench is metaphorical, but the physical threat is very real. To force them to give up private keys, seed phrases, access credentials to their digital wallets.
So literally threatening people for their keys.
Exactly. These are not hacking attempts, but real-world physical threats targeting the individual holder. The fear of such attacks, especially for individuals holding significant crypto in self-custody, where they're solely responsible for protecting their keys, is a powerful driver for them to seek more robust security solutions. This often means moving assets to centralized custodians, major regulated exchanges, specialized institutional custody services. While this contradicts the core ethos of decentralization, self-sovereignty, not your keys, not your crypto, it's a practical, understandable response to a very real, dangerous threat. The trade-off becomes one between ultimate personal control and the professional-grade physical and digital security offered by specialized third parties, a choice many are increasingly making for peace of mind.
So understanding these evolving regulatory and security measures is crucial for you, the listener. Why is it so important to stay informed about these complex developments?
It's absolutely crucial for protecting your digital assets, making informed decisions about where and how to engage with the crypto ecosystem. Knowing the regulatory landscape helps you understand what's legal, what new regulations are coming, what risks you might face depending on your jurisdiction, the platforms you use. Operating in a jurisdiction with clear VRA-like rules is vastly different from one with uncertain or hostile regulations. Furthermore, understanding security threats from sophisticated cyber attacks to physical coercion like wrench attacks allows you to choose appropriate protective measures, custody solutions, whether that's hardware wallets, multi-signature setups, or reliable centralized custodians. It's about navigating the legitimate pathways being created by regulators and institutions, recognizing trustworthy services, and simultaneously understanding and mitigating the potential risks inherent in this rapidly evolving space. This knowledge empowers you to participate safely, effectively, and confidently in the digital asset economy.
From security, which can often be a source of anxiety, let's pivot to one of the biggest, most exciting stories of the past year: the explosive, almost parabolic growth of stablecoins, and the constant innovation under the hood of various blockchains that continues to push the boundaries.
Absolutely. The growth of stablecoins has been truly explosive. a testament to their utility, increasing acceptance. We've seen undeniable indicators. Google search volume for stablecoins hit an all-time high. Massive surge in public interest, awareness, reflects broader curiosity. Even more concretely, their market cap recently topped a record $270 billion.
$270 billion for stablecoins alone.
That's right, a massive milestone. Signifies not just increased adoption, but also growing regulatory clarity in some jurisdictions, which fuels more investment, usage. For instance, this growth was significantly boosted following the passage of the Genius Act. This landmark legislation provided a clear federal regulatory framework for stablecoins in the U.S., defining their legal status, operational requirements. This clarity has significantly boosted institutional confidence adoption, attracting more traditional financial players, allowing greater integration into mainstream finance.
So why this sudden parabolic surge in stablecoin adoption market cap? What are the primary reasons, especially given they don't offer the same speculative gains as other cryptos?
The surge is multifaceted, driven by their unique utility that effectively blurs the lines between traditional fiat and digital assets. Firstly, they are absolutely indispensable in DeFi ecosystems, decentralized finance. Stablecoins provide a stable medium of exchange, a base currency for a vast array of DeFi activities, lending, borrowing, yield farming, trading. Without constantly converting to volatile traditional fiat, they act as the on-ramp and off-ramp within the crypto-native world.
Okay, so critical for DeFi. What else?
Secondly, they serve as a crucial safe haven during crypto market volatility. When Bitcoin or Ethereum experience sharp price swings, investors can quickly move funds into stablecoins to preserve capital, avoid losses, without exiting the crypto ecosystem entirely. Saves on transaction costs, time. Thirdly, and increasingly important, they serve as a convenient, efficient, often cheaper medium for international transactions, cross-border payments, bypassing the slower, more expensive traditional banking rails like SWIFT. This blend of stability, utility, efficiency is what's driving their exponential growth, making them a foundational layer for the future of digital commerce and finance.
And despite this undeniable growth, obvious utility, I've seen an intriguing observation that big brands are sleepwalking when it comes to stablecoins. What does this imply? Are major corporations truly underestimating their disruptive potential? Or just too slow to adapt?
It implies a significant potential blind spot, missed opportunity for many established corporations. On one hand, could mean they're fundamentally underestimating the disruptive potential of stablecoins to revolutionize payments, supply chains, treasury management, even customer loyalty programs. Might still view them as just another volatile crypto asset, rather than a powerful new financial instrument offering instant, borderless, low-cost transactions.
Yeah.
This perspective leads them to miss how stablecoins could cut operating costs, speed up settlement, open up new revenue streams, bypassing traditional banking fees.
Or maybe they're just slow, bureaucratic.
That's the other hand. Could simply be organizational inertia. Large companies are inherently slow to adapt to rapidly evolving technologies, regulatory landscapes, often wait for clearer frameworks, industry standards, proven mass adoption before committing significant resources. However, this sleepwalking could mean they miss out on crucial first-mover advantages, allowing more agile competitors, innovative fintech startups to capture significant market share by integrating these highly efficient digital tools into their operations. It's a strategic misstep that could prove costly long-term as stablecoins become integral to global commerce.
But it's not all sleepwalking, right? We talked about traditional finance giants actively joining the stablecoin space. That must mean some very big brands are wide awake, making serious moves.
Absolutely. The fact that Interactive Brokers, a major global brokerage, is exploring a stablecoin launch, joining ranks with JPMorgan Chase, Citigroup, who are already deeply involved, completely refutes the sleepwalking narrative for these particular behemoths. These aren't small players. These are traditional finance giants actively building the future of financial infrastructure with stablecoins at its core. JPMorgan, for example, already deployed JPM Coin for internal wholesale settlements. Citigroup exploring its own digital asset capabilities for corporate clients. Their involvement validates the technology on an unprecedented scale, injects massive institutional liquidity, significantly accelerates regulatory clarity needed for broader adoption by other large entities. Signals stablecoins are becoming an undeniable, fundamental, strategically important part of the global financial landscape, moving beyond niche utility into mainstream adoption by the most established players.
And what about the underlying technology, the stuff that powers all of this? We heard that strong opinion about NFTs and meme coins earlier, but what's next for the networks themselves, the blockchains underpinning this whole digital economy?
The underlying blockchain tech continues to advance relentlessly, often out of the public spotlight that focuses on price movements, speculative assets. Take Solana, for example. Network known for high throughput, low fees. Its scalability is critical for long-term viability, ability to compete with traditional financial systems. A major development on that front is FireDancer.
FireDancer, what's that?
FireDancer is a completely new independent validator client for Solana, built by Jump Crypto. Poised to significantly speed up Solana's transaction processing capabilities, make the network more resilient. Aims to achieve unprecedented transaction throughput, potentially millions per second, reduce latency even further. However, important to note, while potential is immense, it won't immediately reach full capabilities upon launch. Implementing such a major upgrade requires careful integration, extensive testing, optimization across the network, but its importance can't be overstated. Scalability solutions like FireDancer are absolutely essential for blockchain networks. Handle increased transaction volumes, support more complex applications like gaming, enterprise solutions, and ultimately achieve wider mainstream adoption without congestion or prohibitive costs.
And we touched on Sui earlier. Mill City Ventures investment. That investment was specifically betting on Sui's blockchain's AI and DeFi capabilities. That sounds like a particularly powerful convergence.
It is, and it points to a particularly significant transformative trend within the blockchain space. The fact NASDAQ-listed Mill City Ventures earmarked $441 million for Sui, explicitly citing its AI and DeFi capabilities, highlights a growing belief that artificial intelligence is increasingly seen as a synergistic partner for decentralized finance on blockchain networks. Imagine AI algorithms optimizing DeFi strategies in real time, executing complex trades, managing risk across protocols, providing highly personalized financial services on a decentralized network without human intervention.
Or AI fraud detection built right in.
Exactly. Or AI models generating novel financial instruments on-chain. This convergence aims to unlock new levels of efficiency, intelligence, automation within the DeFi space, promising a more sophisticated, robust, powerful, decentralized financial ecosystem. It's where the cutting edge of two of the most impactful technological trends of our era intersect, potentially leading to completely new forms of financial interaction, wealth management.
So the broader picture here is that while headlines often focus on price, market fluctuations, the core of the crypto space continues to be driven by relentless technological innovation, building the very foundations of future digital economies.
Precisely. It's incredibly easy to get caught up in daily market fluctuations, speculative booms, inevitable busts. But beneath that surface noise, developers, researchers, innovators are constantly pushing the boundaries of what's possible with blockchain technology. This innovation isn't just about creating new tokens or even new financial products. It's about building more efficient, secure, transparent, accessible financial systems, as well as entirely new types of digital applications that fundamentally change how we interact online. From scaling solutions like Solana's FireDancer to new consensus mechanisms, enhanced interoperability between blockchains, integration of AI into dApps, the foundational technology is evolving at an unprecedented pace. This continuous innovation is the real engine of long-term value in this space, quietly laying the groundwork for the next generation of digital services, financial products, even entirely new economic models that will define our future.
So what does this all mean? We've covered a lot of ground today, from global economics, potential debt doom loop, to specific market moves for Bitcoin, Ethereum, other alts, and the very technology underpinning it all. It's been quite a journey through the current crypto landscape.
We have indeed. To bring it all together for you, the listener, the core themes are strikingly clear, deeply intertwined. We are witnessing the undeniable maturation of institutional engagement with digital assets, moving beyond mere speculation to strategic portfolio allocation, corporate treasury plays. This is happening amidst a complex, dynamic dance of market forces interacting with evolving regulatory frameworks, slowly but surely bringing order, though often with differing approaches globally. And crucially, underlying all of this is the relentless march of technological innovation. Continues to build out the capabilities of blockchain networks, creating faster, more intelligent, more versatile systems.
And it's important to remember this isn't happening in isolation, is it? The crypto world isn't some separate insular universe.
Not at all. Crucial to reinforce that the crypto world is not a silo. It's deeply, increasingly interconnected with global finance, geopolitics, technological advancement. Ray Dalio's macroeconomic concerns about a potential debt doom loop in the U.S. directly affect how sophisticated investors view Bitcoin as a hedge. Regulatory decisions in the U.S., clear frameworks emerging in Dubai, cautious approach in the UK directly impact market access, investor confidence, legal pathways for crypto businesses, and breakthroughs like Solana's FireDancer or Sui's AdaFi capabilities aren't just technical curiosities. They fundamentally reshape the landscape of what blockchain can achieve, attracting new capital, new use cases. Everything is connected. Understanding these interdependencies is key to grasping the full picture. This isn't just a collection of news items. It's a living narrative of how money, technology, power are being redefined in real time. What you've heard today are snapshots of that redefinition, guiding you through the forces shaping the future of finance, recognizing that digital assets are no longer just an alternative, but an increasingly integral part of that future.
As we wrap up this deep dive, it's clear that the crypto landscape is as dynamic and full of surprises as ever, constantly evolving, challenging our preconceived notions.
Here's a final thought for you to mull over then. Given the increasing push towards centralized custodians, driven by very real security concerns like those wrench attacks, the significant rise in corporate crypto treasury plays, where major companies hold these assets on their balance sheets, and the growing web of regulatory frameworks attempting to define and control the space, how much of crypto's original decentralized ethos will truly endure or perhaps adapt as it becomes more deeply embedded in the mainstream financial system? And what does that mean for you, the individual participant in this evolving space? Where will the ultimate balance lie between the practical needs of security and accessibility and those foundational principles of decentralization and individual sovereignty that first captivated so many?
A powerful question to consider as we look to the future. Thank you for joining us on this deep dive. Until next time, keep exploring, keep questioning, and stay well informed.